Doing the intro today for Warren Peacock. You find him at thetradersplace.co.za, and he's going to be looking at Pennants and the like. He's going to be looking equities, but also, as always, ALSI. Around about half an hour, we'll take questions. If you've got them, throw them into the Q&A box on the GoToWebinar application, and then we'll pick those up at the end of the presentation. Give me a sec. I just need to click some buttons and hand over to Warren.
Thank you, Simon. Welcome, everybody. Today we're going to have a look at flags and pennants for the ALSI firstly, and then end-of-day shares. The idea behind flags, the instrument has a long move in a direction, then a 38% retracement in a narrow sloping channel against the initial move. The market's always going to move in steps, so it'll move up, then it'll pull back, and then it should move up again. Usually look for steps of 3, and flags and pennants are one way to measure that 3-step move. With a flag, very little pressure is built into the pattern, and it's more of a relief correction. Normally short-term longs getting out of their positions, they have to sell out, the market comes off, and then buyers come back in. Price then breaks out of that channel in the direction of the prior move. Flags are reasonably common on all time frames for the ALSI itself. Let's go and have a look at some pictures. Here we have a 5-minute chart. I put the date up there for you to have a look at a flag. We can see a large initial move, a couple of 100 points up. The price then only pulls back 38.2%. This is just one way that we can apply Fibonacci, but it's not just the fibs. It's also the chart pattern. You can draw the channel over the bodies of the candles or the wicks. And the reason I say that is whichever one looks better is the one that we want to use. Obviously the wicks are just extreme points. Sometimes they're valuable, but a lot of the time they are pointless to look at. In this example, we have the price pulling back to 38.2. We then see price moving up. It breaks the upper channel line. It closes above, and the second candle then continues in the direction of the breakout, and that would be a buying area. I've got some more detail on the next slide. The blue circle is the entry area that we've just looked at. Entry is on a close above the upper trend line. In other words, the open of the second candle after the breakout. Target 1 would be the 100% or the top of the previous move, which is often referred to as the pole. So target 1 is the orange circle over there. Target 2 would be 113%. In this example, it was 80 points. And then target 3 would be the ultimate target for this particular picture, was the 127 level. And if the market's really in a running mood, you can go as high as 161.8. The initial hard stop is the midpoint of the channel. And you can see I put a little circle there. It was 40 points in this example. Sometimes you can use the 38.2 area close below that as a stop, but it does depend on your risk-reward ratio. If I'm only going to make 40 points to target 1, then I don't really want to risk more than 40 points on a hard stop. Now that was a 5-minute chart we looked at. The smaller the time frame, the smaller the targets, the smaller the stops. And here I've got an example on the hourly flag. And we can see in this particular channel, we had far more volatility. So we had a nice long breakup. The market pulled back step 1 to 27.6. It then reversed up again. It failed to break new highs, and it made that common ABCD chart pattern and stopped it really close to the 38.2% level. Draw a parallel line across from the two bottoms and copy it across to the top, or you could simply draw it from the two top points and make a copy and put it down the bottom, make sure that they are parallel. The market breaks out. The second candle open is the entry point. Target 1 is the 100% level, and target 2 is 113. Let's go and have a look at the detail here. Entry on a close above the upper trend line, which is our blue circle. Target 1 is the previous high, is 120 points. And we can see that there's a difference between your targets on a 5-minute chart and your targets on a 1 hour. Target 2 is the 113% level, which in this case is 240 points. And target 3 would have then been 127, which was 370 points up, but not reached. The initial hard stop was again the middle of the channel, or 140 points. Now, for some traders, that would be too big. In other words, the risk reward is not in your favor. You've got a 140 point stop with a 120 point target. And yeah, for some of us, that's a little bit on the rich side. But the whole idea is that if your flag works out, the probabilities are very high that it will go to at least target 1. The idea on the reverse side of this, of course, is when that particular flag pattern fails, and I consider that the 38.2% level. If it breaks below that, then I sort of cancel out these flags and redraw the picture. On the end of day side of things, we've got a daily flag on discovery here. I see I didn't put a date in, but it is going back a year or two. The market moves up. We can see support down at the bottom. The market moves up slowly at first, doesn't make any new lows, continues up, and on the daily chart we can see very little of the ABC effect. What we do have is a small little ABCD over there, but not very clear. What happened here, the market came down to 38.2. It had very little volatility. In other words, the market wasn't bouncing around in that channel. It was a very narrow channel. Remember what I said earlier, it is a low pressure chart pattern. It doesn't narrow down, but it stays within a nice tight range without the trend lines coming together to make a triangle formation. The market breaks out, so we can see at the time it broke out, it was two red candles that did the closing above the channel line. It was a bit of a hammer going on. This is not the simplest trade to take. Psychologically, you're going to look at that and say, red candles. The whole idea there, guys, is to have a look at it and say, what is it going to cost me to actually find out whether this particular trade will work or not? And the definition is the 38.2% level will be your initial hard stop. Entry is on a close above the upper trend line. Target 1 is the previous high. In this example is R3.26. Not share price though, but value per share. Target 2 is the 138. Notice that the end of day charts have slightly bigger targets. If you go to 113, then it's a little bit on the low side. So 138.2 for the extension, in this example R8.90. Target 3 would have been 161.8% or 12 Rand. You can work all these things out before you actually enter the trade. Remember, it's an end of day chart, and even on the hourly, you've got a whole hour to make up your mind what you're going to do all your measurements, calculate how many contracts you're going to take. The ultimate target is, the 178.6 level. That is generally not something I'll hold for. I mean, you can see as discovery moves up and up and up and up, it starts to fail at that 161 level, the purple line. And as it fails, we've got a couple of red candles, then we get a retrace, move back to that level, another red candle. That would certainly be an indication to exit the trade. One of the questions I do get asked from time to time is, is it possible to catch an entire move? And the simple answer is no. All we want to do is we want to make sure that when we make a profit, it outweighs the losses. You can have a 50-50 trading system that can still make you a lot of money just by simply having a target that is double your stop loss. Okay, we're going to move on to the pennants now. This is a chart pattern that actually does show pressure. The instrument has a long move, so similar to the flag, in a direction, then it pulls back 38.2%, but it forms a triangular shape. So when you draw your upper and lower trend lines, they actually start making a point, and that has to be against the initial upward move. Look, there's not enough time to do longs and shorts. I only did longs in these examples, but the same things are true for the shorts. Pressure is built as buyers and sellers fight it out in a narrowing range. Price then breaks out of the triangle in the direction of the prior move. The downside, a proper pennant is reasonably rare. It's not something that you see a lot of. When you day trade on the ALSI, or you're looking at the hourly or even a 5-minute chart on the ALSI, you often get small little triangles, really on the small side. Those are very difficult to trade because you're never sure what's going to happen, and not enough pressure is built for the breakout to be yeah, let's say 70% in the direction of the expectation. Whereas the bigger the triangle, then the better the probabilities. See how on an ALSI 5-minute chart on the 16th of April, we had a lot of pressure building up on the 38.2% level. You can see the candles were coming down regularly. The wicks were breaking through, but the bodies weren't. Nice pressure built up as the price starts to narrow down into a range. This actually happened just the other day. The market breaks out. Second candle after the breakout is an entry. We go to have a look at some detail. The little blue circle was the entry area. Market breaks out. Target 1, as usual, is the 100% move, or in this case 110 points, which is pretty decent on a 5-minute chart. Target 2 is the 113% level. The little green circle is 175 points, and then ultimately the market hit 127% or 250 points. The downside of this, guys, is when targets are hit and the price doesn't really follow through on it, we should really be taking our profit. If we had waited for the 127 level, the chances are you would have been freaked out by the time it breaks, to this low over here. It's right back in the range of that pennant. It breaks down here. You close out your trade at a tiny little profit, or maybe a small loss, only to see the market return to the 127 level. Now, the idea is there's a couple of ways to trail your stops on these things, and it works for the flags and the pennants. As the levels are broken and the market continues in that direction, here we can see a big green candle through the 100% mark. It then gets up to the 113 level and starts to fail. We get a nice shooting star over here. Market closes back down below that level. We actually had a bearish harami pattern over there. You can use that to take your exit. It is 175 points after all. And this actually took quite a few hours to build. Taking profit is how we make profit. But we have to take reasonable profits. We can't be going out there trading for 5 points or 10 points above cost and expect that we're going to make decent money over the next 3 months. The idea is that when the market gives you an opportunity to take a decent profit, and I'm saying over 100 points a trade, it's a good idea to be really prepared to take it. I'll cover a little bit of money management at the end of the patterns. Sasol also built a pennant. Now, what happened, a lot of guys would call these triangles. Triangles tend to occur over many, many months and are larger patterns. There's more volatility in them, and very often the poles are not very clear. So we can see on Sasol, there's a nice clear pole. The market comes down, it vibrates around that 38% level for a good couple of weeks. And we can see at the bottom a little bit from September through to the end of October. So it's 1 month. That's not really enough for a large triangle formation. Sasol then breaks out of that pennant, starts to move up. The next day is the entry, the little blue circle. Target 1 would be a move above the 100% mark. And the reason I use Sasol here is it actually pulled back below the 100%. Now, it's easy to say, oh, okay, we should have caught the whole trade. We would have caught it all the way up to 161.8%. The reality is different. Your stop loss is when the market returns below the target. As in any of the trailing stops that you guys have seen with me, the target becomes the new stop loss. When the market closes below that, take your profit. And if it is a loss, like in this case, it would have been a very small profit, that long red candle over there, I'd rather do that than watch it become a losing trade. Flags and pennants failures. Should price fail to reach target 1 before breaking below support, the pattern is considered failed. The alternative trade is to enter on a failure with a target of 61.8% of the pole. It is a tough trade to make. It's not the easiest thing in the world to do. It can be lucrative. My recommendation, if you are going to do that, is to do it a little bit on the smaller side until you're totally used to doing it. And only then will it actually start making sense to you. Often failures are good trades, especially if it's a classic 38% retracement and the market fails to break higher but rather breaks below that support level. I find that more valuable than a simple support line failure. On the money management side, we're just going to go back quickly to one of the ALSI trades. Once again, it's very dependent on capital. So obviously you have to know that you can handle, in this example, 140-point stop loss on one contract. But what can be done is you can take 2 or even 3 contracts. And if you don't have enough of the ALSI, there are other options. You can trade the smaller contract, the ALMI at 1 rand a point, or maybe one of the CFDs on the SA40. If you buy 3 contracts, always realize that your stop loss is going to be 140 points times 3. Target 1 is taken out, you can close out 1 contract. If target 2 is hit, you can close your 2nd contract. The 3rd contract can then just be trailed on the stop loss. It's a reasonably simple way to do it. Once you're over the idea of 140 points times 3 contracts on the stop side. So target 1, close 1 contract, target 2, close a 2nd contract, 3rd contract works on a trailing stop. When it comes to shares, it can be a little bit more difficult to tier your trades, but you could, for instance, take, let's say 750 Sasol shares, and every time it hits a target or breaks through a target, you close out 250. The other idea is on Sasol here, we actually see what looks like a flag. The reality is it isn't a flag. It came back more than 38%, and the rule for these things is a 38.2% retracement before we look at entering the trade. On the failure side, I don't recommend taking too large a position on these things, especially the ALSI. For those of you that have traded regularly, you know that the support and resistance levels are often false broken. In other words, the market will break that support level, fail to follow through, it pulls back into the pattern, breaks the top of the pattern in the direction you expect, it fails to follow through again. When we start seeing that kind of stuff, then delete your lines, redraw them in. The probability is high that it is no longer a flag or a pennant. These 2 trading systems allow you to make individual trades based on criteria that are strict for a defined setup. Once you have a trading plan that is simple, you can begin making consistent trades that return consistent profits. Yeah, at the end of the day, any trading system that works. What makes it profitable is your money management strategy. So long as you can take your stops when the trade has failed and you have a definition for that failure. So here I've given it, for instance, at 38.2% to close below that. The pattern has failed. Delete the lines, start again. And once you can do that, you have to then allow your profits to hit their targets. What often happens is we get so excited that the trade's actually made a 30-point profit. We grab that profit and think we're very happy with the whole thing, and then the next trade stops out at a 100-point loss. So please, guys, just remember the plan must include money management. Follow the money management over the plan every time. All right, thank you, guys. If there are any questions, please pop them through. Sorry, I have included a 65% discount for new clients. So the 1-month coaching sessions would be 700 Rand. Again, I haven't put an expiry on the offer. Please quote the coupon number 4JOL. I have restricted it to 5 people due to numbers.
Thanks, Warren. Yeah, because apparently it's quite packed, because apparently everyone quite loves it. And if you're watching the video of this, like down the line, it's probably expired. You can drop them an email, but it's probably expired. If you've got questions, folks, pop them in the Q&A box. We'll certainly take some questions. A few coming through already. One fairly simple one. Warren, which software do you use for your ALSI charts?
I use Terminal Velocity.
Terminal Velocity. There's a link on that from your website, is there not?
Yes, there is.
Yeah, because Terminal Velocity, I don't think you go direct through them. You've got to go through introducing agents such as Warren. So head to his website, thattradersplace.co, you'll find links there. I had a look at the platform about a year or 2 ago, and it looked really good. I keep meaning to go back and haven't yet had another look at it. Another question coming through, and I think I know the answer to it, but I'll throw it to Warren. Most important part of trading, and if someone says to you, what's the one thing that's most important?
making sure your stop loss is not too big for the account.
Risk. Always comes back to risk, absolutely. Another question coming through, do timeframes matter massively? Could I do the same thing in a 5-day, a 5-minute or a 1-day or even a weekly chart?
Yeah, once you go under 5 minutes, for instance, on an ALSI 1-minute chart, you can get lots of these things and thereby increase the failure rate. The idea is have a look at the time frame that you are interested in and count how many of these flags and pennants have appeared there and how many of them have worked. So on a 1-minute chart, if you went and did that analysis, let's say over 3 days, and you found 20 patterns, of which 12 failed and the 8 worked, then it's not really a valid chart pattern. I do find anything higher than 5 minutes, these things are more reliable.
Yeah, and it hurts my finger if I can't do more than below 15 minutes. It's just far too hectic. Another question coming through is, you always do this in candles, you don't do lines.
That's great. Candles give me a visual picture of what the market is feeling. And I use them consistently, and the better you get at reading those patterns, the simpler it is to make trades.
Question coming from Lauren Locke, flag and pennant is not one if there is no pole, question mark?
Correct.
So you need that initial run up in a sense.
Initial straight line up, then a small, over time it must be a smallish triangle for the pennant and a smallish channel for the flag.
David's asking, would you keep an ALSI overnight? And let's tie it to this. If you got a flag that triggered at, say, 4:45 and at 5:30 it was still going, would you hang on or would you close?
Okay, that really depends on time frame and expectation. Anything under an hour, I don't like to hold overnight. On the hourly, if I've got a target of 200 points, I'm almost prepared to take the risk overnight. One of the other rules is on the hourly, I don't like to trade after 4:30 in the afternoon. On the 5-minute chart, same sort of rule applies. I don't tend to be looking there after 4:30. 5-minute chart, don't tend to hold overnight. Hourly chart, I can if there's enough profit potential.
Cool. Ladies and gents, I'm not seeing any more questions coming through. So my thanks, as always, to Warren for his time this afternoon. Take him up on his coaching offer if you're interested. And my thanks to all of you for attending. Thanks and cheers.
Thanks, Simon.